Hi there, happy Friday. I am Nathan Garcia, and I'm so happy to be with you to share my thoughts on the fourth quarter GDP print. You may have just seen this number come out, and it showed a 4.1% figure, basically showing that the US economy grew by 4.1% in the second quarter of this year. And so, if you have been following this number, then you may be looking at it and saying, is this really a positive for my portfolio, for my retirement investments, or now do I need to make some adjustments because of this? And so I wanted to dive below the surface number here, explain how we got to that 4.1%, and then give you some different factors that I'm watching, that my team's watching, so that you can make an educated decision about your future. So the first thing is that the second quarter number that came out was very strong. It's the strongest number that we've seen since 2014. And one thing that you want to remember as it relates to this fourth quarter GDP print is that that number is going to be revised over the next 2 months. So we'll see a second version of it here in August, and then we'll also see another version of it in September, and it'll continue to be revised for the next 5 years. So just because it came out really strong today doesn't mean that it's necessarily going to stay that way going forward. Now, the other factor that you want to consider is that this number was expected by some banks to be as high as 5%. And so the fact that it's actually 4.1% is on the lower end of expectations there. And when we look at how did we get to that 4.1% number, one of the big factors that I find very interesting was the number of exports going to China, the agricultural exports going to China. That amount actually added to about 1% of the GDP number. So about 25% of that 4% figure was attributable to Chinese companies buying agricultural products, soybeans, ahead of the trade wars. And so what that tells you is that these companies are essentially pulling purchases that they would have done forward. And so we may see in subsequent quarters, quarter three, quarter four, going forward, that those sales that we're expecting aren't going to show up. Essentially, we've pulled them forward and they will be missing in the next couple quarters. So that's something that you want to look at. The other thing that we want to look at is how did domestic spending add to this? And what we see is that domestic spending actually went up. So personal consumption actually went up. PCE, that went up. And that shouldn't be a huge surprise when we think about the timing of the year. Most people get their tax returns back in April or early May. And so that probably had an influence on how much people were spending, what have you. It's very interesting to look at it's very interesting. Sorry. It's very interesting to look at the figure, though, because it is showing that we do have great growth. And if we stayed at this level for the second half of the year, then we may have a GDP print for the year over 3%, which would be huge. But we really have to be wary of that potential because of the impact that the trade wars are going to have. And then also remember that the dollar has strengthened pretty significantly. And so that's going to have a negative impact, or it could have a negative impact on exports and some of the companies here. One other thing that I wanted to mention is, the GDP print is great because it shows the economy is growing, but it also gives the Federal Reserve a reason to potentially raise rates. And so last week you had Jerome Powell on Capitol Hill discussing, what he sees in the future with the possibility of raising rates. He said that it's not out of the realm of possibility to raise rates 2 more times before the end of this year. And so that with a solid GDP print, essentially what you want to do, or what the Federal Reserve may want to do, is raise rates because the economy is really moving forward. However, a lot of this is in flux because we really don't know, how much of the GDP number itself was a result of companies trying to prepare for the impact of trade wars, how further trade wars or threats could impact the economy. And then also when we look at some of the big factors here with like spending, personal spending, is that going to be a continued sustained trend? because when we look at the first quarter of this year, it was actually about 2%. So there's a lot that you should take into account here with looking at the second half of the year. I saw something yesterday that I thought was really interesting, is that three stocks have really held up the S&P 500. They've made up 70% of the gains in the S&P 500 year to date. And those are Netflix, Amazon, and Microsoft. And so when we see that the breadth of the market gains are being narrowed to just a few companies, that doesn't signal that there's widespread growth. And so if the economy is really growing and it's really strong, then we'd expect that to be spread out and distributed on a broader basis. But that's not necessarily what we're seeing here. So as it relates to your portfolio and your retirement plans, you really want to be aware of what is the maximum drawdown in my portfolio in the event that we do see the market start to pull back, especially if interest rates rise. Because remember, as interest rates rise, people are going to be compelled to look at their positions in the stock market and say, is it better off for me to just invest in a guaranteed bond that's backed by the U.S. government, or should I have that money in the stock market and just get the dividend payable through these companies? Recently, with the interest rates increasing, now the rate of return that you can get from a bond is actually higher than the dividend rate from the S&P 500. And so if that's the case and you're a conservative investor and you're looking at preserving your capital, you may be more attracted to the bonds and the fixed income that's going to offer a higher rate than what you could get from dividend paying stocks. And so for that reason, we may see more institutions and bigger investors start to make that move and thereby pull some of that money out of the stock market itself. The other factor, of course, is going to be the rising interest rates. As interest rates rise, then you want to position your portfolio to take advantage of them. Especially when you look at the short-term notes, 2-year or 5-year notes, and what they're returning relative to a 10-year note or a 30-year bond. It's pretty significant. So there are a lot of different factors that you want to account for in your portfolio. And while this number is great, and you're going to hear the GDP number repeated over and over again by Trump and his administration as we get ready to go into the election in November, what you want to keep an eye on is, how much of that is temporary, how much of it is transitory, and then also if that number is significant enough for the Fed to raise interest rates, how's that going to impact your portfolio? It's like that old Wayne Gretzky saying that you want to skate to where the puck is going, not to where it is now. And it's the same thing as you look at your retirement portfolio for the second half of the year here. So I hope that you found this helpful. If you did, leave me a comment below. I'd love to hear back from you. And if you have any questions or you have any topics that you'd like covered, leave them in the comments below, and I'd be happy to do a quick video for you. So thanks a lot. I hope that you have a great weekend and look forward to connecting with you next week. Thanks.